Good afternoon, everyone, and thank you for joining CanCambria's Investor Update webinar. I'm Josh from Kin Communications, and I'll be your host today. Today's presentation will provide an overview of the company's recent progress and key developments across its Kiskunhalas project in southern Hungary. This will be followed by an audience Q&A period. Attendees can ask a question at any time during the presentation by using the Q&A button at the bottom of your screen. A recording of today's event will be available shortly after the end of the presentation. Before we begin, please note that today's presentation may contain forward-looking statements. We encourage everyone to review CanCambria's public disclosure documents available on SEDAR+ and the company's website for important information regarding risks, assumptions, and other factors. With that, I'm pleased to turn it over to CanCambria CEO, Dr. Paul Clarke.
Thanks, Josh, and welcome to our webinar. Thanks for joining us. Good afternoon and good evening, wherever you may be scattered around the globe. It's great to be here and to share a little bit about the strategy, some of the recent updates the company has, and really to give you some more color on maybe a number of slides that you've seen before, and introduce some new content to our investor base. I've spent the last couple of weeks on the road, a week in London last week, and now I'm in Budapest, Hungary, and the hot heat wave seems to have followed me all the way over here. So I'm extremely thankful that we've got good air conditioning and we've got good power generation and energy security at the moment, and long may that continue as we look to have natural gas as one of the key transition energy sources right the way across Europe. So with that, I'll kick off the presentation. You can see a beautiful view here, a nightscape of Budapest. Of course, that's where our flagship asset is located, about 2 hours south of the capital. The agenda for the presentation today, fairly informal. I'll give you a high-level corporate overview, touch on one or two key dynamics of that European natural gas market. We'll go a little deeper into some of the technical merits of the project in Kiskunhalas, specifically our deep tie gas project, explore resource size, valuation, our development plan, and an update on our joint venture process. And time permitting, we'll wrap up here with an additional few comments on our shallow oil project, this exploration upside that we've introduced to our company really over the last 5 to 6 months. I will talk to some resource numbers specific to the deep play. The shallow oil play, we do not have any independent audited numbers, so all of those numbers are internal numbers at this stage. So as many of you are aware, we entered Hungary with a 5-year plan. We are on year 4, and as you've tracked along here, we've put together a quite considerable acreage position. The goal was to establish a footprint, prove up a significant resource base. We did that in conjunction with a proprietary 3D seismic data set. That speaks to the 572 BCF risk recoverable. So we have legacy well data. The seismic is really what gives us the enhanced confidence around those numbers. Somewhere between 50 and 100 vertical drilling locations identified from our 3D seismic. So we're speaking here about a very sizable risk recoverable valuation, NPV10 in the region of $1 to $1.7 billion US. And the plan forward is to secure funding for those first 2 wells that we have permitted, and hopefully be drilling through the turn of the year, really with first production in 2027 to really cap off that 5-year plan. There really aren't many places in Europe where one can execute such an aggressive plan. We are, of course, pre-revenue. We'll talk about the significant production ramp once we get these wells demonstrated to be commercial. And we strongly believe there's no better place really anywhere in the world than Europe for natural gas at the present time. On the left-hand side of the slide here, we have a few of the key investment highlights, capital structure on the right-hand side of the slide. We have a very compelling growth project. Once we kick off production, once we get the project rolling here, we anticipate somewhere north of 10-20% production growth annually. The macro in Europe is very strong, mainly driven by supply side issues centered around energy security for Europe. Hungary is very attractive, corporate tax, royalty, very attractive, making investment in the country really top class. The resource itself sustains somewhere north of a continuous 10-year program. And probably most important of all, the group we've assembled is very top tier. We have a number of individuals that have worked with large independents, don't have time to go through the bios, but a large independents having drilled and operated many hundreds, if not thousands, of unconventional wells. Share structure is relatively clean, strong insider ownership, no debt on the balance sheet. And as I said, we're poised here for some very important investment milestones, I think, over the next 6 to 12 months as we demonstrate funding for the initial 2-well drilling program, and then a whole series of catalysts as we get these wells down, demonstrate operational, technical, and commercial viability of the project moving forward. I'm sure many of you are familiar with natural gas over in Europe. Really, since we entered the play as a catalyst from Russia, Ukraine, natural gas has traded at a significant multiple to North America. We've seen $9, $10, $11 gas consistently over the last 3 years. Prices spiked here earlier this year as a function of the Middle East, starting to really slightly on the oil side, coming back down on the gas side, remaining relatively high. US prices $3 per MMBTU, so a significant multiple. We're seeing $14, $15 gas in the European sector, Dutch TTF pricing. For reference, our break even is $4, so we have very, very healthy margins for the project moving forward. A huge driver here is Hungary continues to import significant natural gas. It does that via a combination of LNG, but more significantly Russian pipe gas through Turkey and other areas. And with the Hungarian elections here recently completed, there is more of an EU positioning, which of course mandates a lot less reliance on Russian natural gas and other energy sources. So there is a very significant momentum in Hungary to diversify out of Russian natural gas. We also have a liquids component to our project here, around 30% of the revenue coming from natural gas liquids, oil and condensate. So that would give us a little bit of a buffer on the price side. Geographically, we are positioned south, about 2 hours south of Budapest. On the lower left-hand side of the slide, you can see that the grey polygons represent the 2 main land positions that we have. One of the most significant attributes of the project here is a remarkably low government take. We have a royalty burden here of 2%, which is primarily to incentivize development of these unconventional resources. They are a little bit more challenging to commercialize, so that is reflected in this strong NRI. Typically, conventional projects in this part of the world have a 20% government take, but here we have just a 2%. So the strong royalty and the high natural gas prices really make this project fly. There couldn't be a better time to test this type of project in Central Europe. For reference, the natural gas pipelines are also indicated here in orange. The region that we're in is a proven basin. It's a proven fairway for both oil and gas. Typically, oil is a little shallower. Gas resides in these deeper Miocene age basins, which are in the region of 3,000 to 4,000 meters current drill depths. If you zoom in to that land position, almost 250,000 acres, the image on the right-hand side of slide 7, and what you can observe here is the red polygon being our original land position, our mining license held by production. That is where the majority of our deep tight gas resources are located. That's the area where we acquired a 90 square kilometer proprietary 3D data set. It's within this deep Miocene basin called the Kiskunhalas Trough. Last year we picked up a larger block of land outlined in blue. That was primarily to consolidate our deep Kiskunhalas fairway, but it brought with it opportunity in another deep Miocene basin, the Salford-Ket Trough. We still think that may have some potential, but we're increasingly more and more encouraged by a shallow oil prospect, a whole series of medium to large fields that reside on the margins of that trough as you come up out of the deep basin. And I'll share with you some insights on that particular play. It's a little cheaper to drill, it's a little bit shallower, and really quite attractive to add into our portfolio. So we have these two projects. The Deep Tight Gas project, of course, is the most mature. Some of these key milestones for the project: we secure the land, desktop studies, we acquire 3D seismic, independent resource numbers, drill permits, etc., and approvals. We are on our deep play essentially waiting to wrap up our JV so these initial 2 wells can be funded, and then get the wells drilled and on production early to mid next year. The shallow oil play is a little less mature. We've done our desktop studies, we have the land secured, but we are at the present time evaluating bids to acquire and process 3D across that region to better delineate these fairways. Our business model is the same: low cost entry. We pick up all this acreage for less than $10 an acre, and then we come in new areas, proven areas, adding in technology, 3D seismic, drilling, etc. A bit of an entrepreneurial mindset, and push the value creation for the shareholders via the drill bit. So we will be successful as our wells come online and we add production and reserves. So if we turn our attention quickly to some of the data that we do have within our deep tight gas play, most of the elements that we look to for proven plays are present within this Kiskunhalas deep tight gas area. 3 deep wells. Collectively, we have core, we have logs, so we understand the storage, we understand the producibility, and in fact, all of these 3 wells tested gas to surface. The flare image you see on the lower left was from the BAE number 1 well. That was flowing at around 3 million a day. That well was drilled in 2009 and stimulated a little later in 2011, albeit in a $3 gas environment. That well was deemed non-commercial primarily because it was drilled just outside the main producing fairway of the field. And when we came in and we acquired the asset, we do not have any plugging liabilities from these wells, but collectively they are the smoking gun. They are the data that give us the confidence that the resource is in place and can be produced. What we didn't have was any high degree of confidence regarding the distribution of the resource, which is where the new 3D seismic came in. The seismic really helped us calibrate those wells and then delineate where we ought to be drilling within the sweet spots. And the two wells shown here, the BAE3 and the BAE2, shown with the orange circles, those represent the 2 initial wells that we have permitted and we have essentially ready to drill. This montage here demonstrates that the data set and the workflow. We have logs which demonstrate porosity and saturation parameters. We have pressure data, etc., all of which speak to the storage capacity of the reservoir. We have permeability data which tell us about the producibility. All of these are very good industry standards. So we have an excellent data set. We then integrate the new seismic data, and we can tease out an awful lot of information about the subsurface from that seismic. We can isolate the gas saturated sands, and we can map them through the subsurface. And we do that because we have this brand new fit for purpose proprietary 3D data set designed specifically to image the deep basin, processed to image the deep basin. This technology really was not available onshore around 10 years ago. Certainly 5 years ago, the cost would have been prohibitive to somebody like CanCambria from obtaining this data set, but the results speak for themselves. You can see the image on the far right-hand side is the original 3D seismic from the region. Just out of reference, that is this survey here is the original and the first 3D survey ever acquired in Hungary. And so we come in a number of decades later with all the modern technology, and now we have this new image within the subsurface. You can see, if you follow my cursor, you see the geometry of the basement. You can see a whole number of features, including the reservoir itself, that are not visible from the old data. So they were not able to position those 3 legacy wells with any confidence. They didn't really know, what they were chasing, where they were going. So here now we have a very good image of the bounding faults. Here I'm showing you a couple of maps from our seismic data set. The left is a structure map. The right-hand side is a seismic amplitude. This is the map that speaks to producibility. Yellows and oranges are the good areas. The blues and the grays are areas that are maybe less favorable. Our 2 initial drilling locations are highlighted, number 1 and number 2, within these sweet spots. For reference, we're about a ½ kilometer away from our type well, which is shown in the purple circle. And then at the moment, we're permitting a 3rd location in this up-dip position as we build more confidence stepping out from the original subsurface. So I show you this just to demonstrate that we have, here plenty of room to position many, many more wells, and this fairway specifically will accommodate around 50 vertical wells on 40-acre spacing. Put fairly simplistically, the new seismic data allows us to position the wells very, very carefully. It really does matter where you position the wells. What you will find is that some of the unconventional players out there they will get away with a very marginal resource by using an extremely large area. And we're doing kind of the opposite. We have a very surgical approach. We have a 4,000-acre fairway, and this is illustrated on the map to the right-hand side, and then we selectively put in those 50 to 100 drilling locations. And, there is some uncertainty as to the drainage area. We're starting from a 40-acre, but it may be tighter, it may be wider. We'll learn those lessons as we get through the development program. So with all that being said, we have, I would say, a fairly good understanding of the recoverable gas. As we started out the project, we had around 2.4 TCF of original gas in place for the broad structure. Once we acquired the 3D seismic, we very much focused on the southern margin of the field. That's where the seismic amplitudes told us that the best reservoir quality, gas saturated reservoir quality, existed. So that area did go down, and we anticipated that to be the case. So we start out here with a little over 1.2 TCF, technically recoverable around 715, and then a 20% chance of development, which is consistent with the workflow that is laid out with the Canadian evaluation, oil and gas evaluation handbook, SPE handbook. That then corresponds to, in theory, 100 drilling locations. We put together a phase 1, which is 56 drilling locations. That gives you continuous 1-rig activity over about a decade, and that is the program that delivers around 1.1 billion US. So that's the challenge that we have as a company and as a leadership team, is to build confidence into that 1.1 billion asset valuation. And of course, today we sit with a market cap of around 40 million. So that's the challenge. That's the path ahead of us. And we'll go quite a long way to demonstrating that once we get that initial well drilled and flowing to sales. So big picture, that's great. What does it look like on an individual well basis? And that's, equally important in terms of, we will be judged on our first well. There's no doubt about that. We have a couple of methodologies that we've used. We've used dynamic flow simulation. We've built static reservoir models. We've flow simulated. We've done fairly rudimentary post-stimulation, post-frac flowback and cleanup of various different multi-stage fracs within a vertical well. We've done, again, a simple gas in place using type curves derived from North American analogs, and they all demonstrate a 40-acre well should be able to recover somewhere in the region of 6 BCF, and that's what we built our, albeit sort of simplistic economic model, a deterministic economic model upon. You'll notice this is a very steep initial decline, very consistent with tight gas type of production, high perm near wellbore area, and then draining from the further reaches of the reservoir with this low tail decline, strongly hyperbolic here. What this does for us with these high initial rates and high pressures, we get a fairly rapid payout. The wells, per our model, they recover essentially all the sunk costs within less than a year. And that's at a $10 gas price, and of course natural gas is well above that at the present time. So very robust economics over the longer term, very rapid payout over the short term, which really helps us move this project to a cash flow positive relatively quickly. The timeline here on the upper left, I've included the other types of projects that we have going on, but specifically for the tight gas project, you can see here we have the goal through the end of the summer here is to conclude our JV process. We've wrapped up the data room with the parties. We have broad agreement with all parties that have been through the data room on the technical merits of the project, and we are now past that into negotiating and working through potential terms with various different parties. So we're hopeful that we can get something through the late part of the summer, and we'll obviously announce that to the market at the earliest opportunity once we secure either a binding offer or a general agreement going forward. What I think that looks like is drilling most likely early Q1, and that would be consistent with bringing in a partner that has a budget cycle which needs approvals. We're looking here, of course, for a partner to carry the majority of the cost of the initial 2 wells, and that does become fairly sizable in the region of 36 million. We'd like to drill the 2 wells back to back, but there is, we don't have that second well or first well scheduled. No rig contracts are agreed at the present time. The Kiskunhalas shallow project, we'd look to run that in parallel if it's all possible, and we'll speak to what that looks like here momentarily. But the key takeaway for our deep play is that we have very rapid growth in revenue. As I said, 20% production growth annually over the 10 years that we look to drill out the field, and then the field, of course, goes on long-term decline. This, if you're ever so careful in terms of viewing this, you'll recognize 2026 here has revenue. This is the report that was published by our auditors late last year. We've not refreshed or updated this. What you would want to do is slide this essentially to the right, and the first revenue will come in 2027. We also don't think that we would need this significant capex so early into the program. We have a very good takeaway capacity for up to 7 BCF annually from a local gas storage facility, but nevertheless, the resource and reserve group that we utilize were conservative, and they front-loaded the capex for the pipelines, which of course has an impact on when this project starts to pay out. And for us, I think we see this project, if you drill the wells back to back, well 4 is cash flow positive, so really relatively early into the program. So just a little bit on the shallow play, maybe you ask what is the activity level in Hungary, and it's you don't hear a lot about it, but it is relatively strong. MOL are the biggest player by quite a ways. This is resource based within country. I put CanCambria in here just for interest to see that we can be a very significant player. MOL, being a very large integrated company, don't announce all of the wells that they produce, but they've made a number of discoveries. They announced the large ones. A couple of examples here where they found shallow production to the north of us and off to the west in excess of 1,000 barrels a day. So some very successful wells. We think in this general region, a good well might be somewhere in the region of 400, 500, 600 barrels a day. So we're not counting on, on these highly prolific 1,000 barrel a day wells, but would be nice if we got into some of that. The model is very simple. It's just the basin margins. So chasing the oil and gas as it migrates up and out and is trapped around the flanks of the trough up to the north here. And this is probably the most important slide. What you can see from the rock column is multiple zones are productive, multiple zones are oil and gas productive. This smaller basin shown in green is largely oil productive, and there's a whole series of fields on the southern edge of this margin, this structural high that were discovered in the 70s and 80s as a function of gravity and magnetics. What typically would happen in other areas is that technology cycle would continue. You would apply 3D, and you would find more and more oil and gas. So the gravity and magnetics, they found about 100 million barrels of oil equivalent. 2D seismic came in the 70s into the 80s, and they found another 75 million. So we think conservatively, the application of 3D into this region when 3D was never acquired, we're going fishing here for somewhere in the region of 25 million barrels of oil equivalent. So a very sizable target, and those fields would be all around the edge of this trough. We've done a fairly good job of analyzing all the legacy data. We've used AI to accelerate translating a lot of the documents. Hungary is relatively good for archiving, but the data is in some pretty bad shape. So this is one example where we took sort of various data sets and within a few minutes managed to, with AI, pull together some very coherent exhibits to share with vendors and service companies. And this really is accelerating our learning. It would have typically taken about 2 or 3 days to make sense of this original document, but this stuff gets done in minutes and hours, which is a really big plus. What does a typical field look like in this part of the world? Quite difficult to get production data, but there is one fairly good 2018 source. Hydrocarbons in Hungary is the reference if anybody is interested. And the field size distributions, around 20 fields. It's a log normal type distribution, which is typical of oil and gas. The Swanson mean comes in around 16 million. That's what we're thinking for a mean field size in this region. And that has gross revenue in excess, again, of a billion. Of course, that does not take into consideration any royalties or costs, capex, so on and so forth. But just to let you know that we are chasing a very sizable and a very impactful type of resource. A couple of examples, we do have 2D seismic in the region. We licensed all of the 2D, and we started to work through identifying a number of prospects there. They're shown schematically here. They go anywhere from 200 acres up to 2,000 acres. And there's a good indication from some of the structural closures. We can see faults, etc. But we certainly don't feel confident drilling on the 2D, which is the rationale for the 3D. And we are, as I said, directly offsetting production. And the last comment I do have, there are examples from the 2D where we see these direct hydrocarbon indicators. They are what companies like Vermilion and others have chased down in parts of Hungary and Croatia, where this substantially de-risks the play. We do think there's technology to be applied both to the tight fractured basement and also some of these DHIs where we come in with horizontal drilling. So that's something that we're looking to explore through the end of the year. And we do feel that this shallow play, these are $4 million type wells rather than $18 million type wells. They take about a 2 weeks to drill rather than 2 months. So it really gives us some optionality going forward, especially as oil price may be a little more volatile, and maybe there's some opportunity to move this forward. At the present time, we don't have any locations selected for the shallow play. We don't have any permits approved, but we don't anticipate, that taking really any significant time. So my last slide here before we go to Q&A, I don't think there are many other companies that have access or exposure to the growth side that we do within this European market. We do have these favorable prevailing macro conditions. Natural gas, we think, will stay high over the medium to long term. In our business model, tried and tested, very, very durable. We've done it in other areas. The deep tie gas, scalable, very impactful. JV hopefully coming to a natural conclusion here through the end of the summer. In parallel, we then work through resource evaluations on the shallow play. And all this comes together really in 2027 when we drill hopefully our first and second wells in the deep and also the shallow play. So with that, let me turn it over back to Josh, and I'd love to take questions and keep the conversation going.
Great. Thanks, Paul. We've got a few questions here already, actually quite a few. But just as a reminder, you can use the Q&A button at the bottom of the screen, type your question in. If we don't get to your question today on the call, we will reach out, somebody from the IR team or Paul and his team to help answer your question. So don't worry about that. So just to jump in here, we've had a few questions about the JV. So, you gave a bit of an update. Has the recent political transition in Hungary impacted the level of interest or the types of companies participating in the process?
Yeah. Good topical question. I think it's a little too early to see any, the process we kicked off of back in October, November of last year. So it's a little early to see, and frankly, we don't want really any more inbound at this stage to derail the process that we currently have. What I would say is that the JV process that we had rolling was impacted by the election, and you can certainly understand large companies looking to invest 40, 50, 60 million into a project like this would naturally want directionally to know who is running the government. So the project with the JV essentially stalled for a period of time until we got through the election. So I would say it delayed the JV process a couple of months, especially as we got nearer to the election, and it became apparent that Orbán was not going to prevail. But now we're back full force. The new government in place there, a little more pro EU. So in theory, more transparent. You would anticipate more investment into the country as a function of that. Maybe even more EU money, albeit maybe natural gas is not front of the line in terms of getting those sorts of resources. But we're exploring all those avenues. So the election certainly did play a part, but everything is full force as we move forward.
Great. That's helpful context for the JV process there and sort of overall interest. So if we look at economics, can you talk about how Hungary's low government royalty regime and combined with the strong European oil and natural gas prices impacts project economics and I guess overall value of the Kiskunhalas asset? And one add-on there, royalties on liquids, are they the same as for natural gas?
Yes. So the designation, the unconventional low perm designation is kind of a catch-all both for oil, condensate, natural gas liquids, and natural gas. So the conventional is 20%, unconventional, which is the low perm stuff, is 2%, and really that is the driver. I would also say that Hungary is a jurisdiction that doesn't change the terms. The contract that we executed the mining license. Those terms were reflected here recently when we put together the concession in 2025. So those terms didn't change, and they will not change. I've had a lot of inbound questions from folks. Well, if you make a discovery, do they renegotiate? And there's really, not a whole lot that can be changed in country. There is a windfall tax that was introduced right after Russia-Ukraine, but all of the modeling that we've done is, without going into the details, that windfall tax will not impact any of the projects that we're doing over the first 5, 6, 7 years of the life of the project. So there were one or two things put in place to try and combat these high natural gas prices. We certainly don't want 17, 18, $20 natural gas prices, just because it brings in, really too much attention. And I get questions from other operators saying, Paul, you want to dial down some of the information you put out about how economic the project is, so on and so forth, because people will change the terms on you. And let's not forget that we are trading at a market cap of 40 million because we still have to overcome the commerciality. We're very, very confident from all of the players that we've looked at, from all of the analogs, that we will be up and past and through that learning curve here over the next really the next 12 months. And now, what does the royalty do? What does the natural gas price do? It makes the threshold, it makes the bar that we have to overcome to make these wells commercial very, very low. Our break-even EUR for a well here is somewhere in the region of 1.5 to 2 BCF. We think we'll get closer to 5 or 6 BCF, but these are very attractive economics. So yeah, we think that now is really a great time to test the commerciality of the play. And I see the secondary goal for the team once we demonstrate commerciality, it's to drive down costs. I mean, that is the one thing we get to control, really, Mother Nature, natural gas prices. The cost is, in other basins in North America, examples we've talked about in Pinedale, where, costs and cycle time for the drilling and completions have come down, several, maybe 25, 30, 40%. And so that will be the next challenge for the company once we demonstrate commerciality, then, is to, make those economics even more robust to weather the natural gas price comes down or not over the longer term. So yeah, a bit of a long-winded answer, but yeah, we're thinking about all of those things. And man, now is a great time to test this play.
Great. And, circling back to gas prices, we have a question here about, we mentioned a $4 break-even price, I believe. And is this at all impacted by oil prices?
I mean, of course it is, but not, not it. But we've got a range of gas. We've got the gas liquids ratio. We've got a range there of around 80 to 90 barrels per million. So a typical well could produce somewhere between 350 to 500,000 barrels of liquids. So that's a significant component. The pricing is simply indexed to Brent. But the challenge is you've got to produce the gas. It's a retrograde system, so you've got to produce the gas to get the liquid. So really everything is driven off the gas rate and the gas prices. And there is also with it being retrograde, we don't know the long-term productivity of the liquids. Typically what will happen is these liquids may, over the longer life of the well, drop out. So really we've based all of our economics on the gas, which is a little bit more easy to predict, a little easier to model. In our models we used $10 gas, $65 oil pricing, which seems to be fair. I got a little bit of pressure to go revisit those numbers when oil was at 100, but it was such a short-lived spike that we don't necessarily see that. When what I will say is Hungary, we talk a lot about natural gas, but Hungary is also desperate for liquids. And there's good refining capacity in country, a great market in country. So yeah, we have a natural market for the liquids to refineries in close proximity.
Right. That's I think that's helpful for everybody. And then, you sort of mentioned a bit about Hungary and their strategy. So, how do we think about Hungary's focus on sort of energy security and things like that? And how does CanCambria's project fit into that long-term strategy?
Yeah, we're still watching, interested to see, directionally the new government there. They've already come out and they've already come out on described support for EU's policy to move entirely away from Russian gas by the end of 2027. That is no insignificant task. They recognize that will be quite tricky. We could, in theory, getting our project up to scale, we could offset any decline in natural gas with our project as we bring our project on stream. It can be, very significant. Domestic natural gas production around 150 million cubic feet a day. Our project at scale will get quite close to 60-70% of that domestic production. So we can be a very significant part of that conversation. Having said that, Hungary continues to produce about 30%, 25-30% of the natural gas that it consumes. So they still need to balance. They still need to balance where the rest of that natural gas comes from. We see synergies with companies in the region where this technology. We'd love to take our technologies. We'd love to take our business model to other basins within country and within the neighboring regions. But as you might imagine, at the present time, due to capital constraints and getting the initial project up and running, we've focused and we've turned down actually a number of folks coming to us wanting to partner with us on other opportunities there. We think that once we get into revenue, there's a lot more opportunity than just the simple Kiskunhalas footprint that we currently have. So yeah, I think there's a lot that we can do. Natural gas, it's going to be part of the energy mix for the next several decades. It really will not change, and I think it's important to recognize that and invest in some of these really strategic projects.
Yeah, that makes a lot of sense. I think based on some of these questions we're getting, our financial slide didn't make it into the final version, so sorry about that for those people asking financial statement questions. Maybe we'll just kind of touch on one last question here before we wrap up. But anybody who asked a question, don't worry, we'll be reaching out to you. How much ownership does management have?
Yeah, we're around management around 7%.
Okay, great.
Yeah.
And then Paul, I'll just hand it over to you and maybe tell people as you wrap up what they can look forward to in 2026 in the second half and also into 2027.
Yeah, thanks, Josh. Appreciate it, and thanks everyone for sticking with us. We covered a lot of ground. Hopefully, you found some part of what we just described informative, and feel free to reach out to Josh or Larry Basnardo or any of the folks of the company here. As I said, we are working extremely hard to bring this joint venture over the line. That really is absolutely critical to get these first 2 wells drilled. We are diligently working this shallow oil project in parallel. We do not plan to offer that as a JV. That is a nice bite-sized type of project for the company, and we want to shoot 3D. It's around $3.5 million to do that. And once we know the size, the scale, we can start to put together a drilling program. We'd like to be drilling our deep tight gas play in Q1. We'd like to be drilling the shallow oil play mid-year next year. So hopefully next year is really dominated by operations and getting a lot of learnings and hopefully getting production on stream. We'll continue we'll continue with all the initiatives that we've got to make the market aware of the company, what we're trying to do, the business model, and I hope that we can get something out on the JV over the mid to late summer would be ideal. So again, I appreciate everyone's interest in the company, and thank you all for your attention.